Hi, I'm Chris Wallbank, Executive Vice President at Chesswood Group and a member of our portfolio management team. I wanted to share our thoughts around private credit as an asset class and the role it plays in portfolio construction. I will address the following questions. What is private credit and what are the drivers of demand? What makes Chesswood Capital Management private credit different from other investments and what are the benefits to our unit holders? And lastly, how does private credit help investor portfolios? What is private credit and what are the drivers of demand? Private credit can be broadly defined as a lease or loan that is originated through non-public channels such as exchanges or recurring syndication programs. This type of lending can come in many forms such as direct lending to businesses, factoring, LBO financing, mezzanine debt, or asset-backed lending. There are a few factors driving demand for private credit in the marketplace. Banks have historically been the lending partner for private companies. However, increased regulation following the financial crisis has limited the capital available to private companies from traditional banks. The fallout from the financial crisis, in addition to the development of regulated asset-backed fixed income securities, has resulted in institutional investors taking the place of traditional financial institutions as capital providers. Traditional banks have a narrow credit box and will only lend to those that satisfy it. Private credit enables independent lenders to underwrite credit to niche assets or businesses in select markets that are not well understood or priced by traditional banks. In addition, the number of publicly traded companies has declined in the past 25 years, increasing private borrowing options for a progressively larger pool of companies. Smaller companies have less flexibility in securing capital as they cannot access public capital markets. With regional banks in the United States under financial duress and shrinking their lending base, the situation for smaller mid-market firms accessing private credit becomes ever more compelling. Private credit has filled some of this void through the likes of pension funds, insurance companies, foundations, and family offices. The sustained enhanced return compared to public market equivalents has further contributed to the growth of private credit lenders and private credit funds. In the past 2 decades, private credit returns have outperformed public loan and high-yield market equivalents. As a result, we are now also seeing increased interest from retail investors who can access private credit through a fund structure. Investors are growing more comfortable with viewing private credit as part of their fixed income portfolio, rather than simply a niche alternative investment. The stability delivered by private credit and premium yields relative to traditional fixed income instruments are some of the factors driving this shift. What makes Chesswood private credit different from other investments, and what are the benefits to our unit holders? Well, private credit, for our purposes, is a fancy way of saying that we make leases and loans directly to businesses and consumers that are secured by the assets being financed. These assets range from excavators for a construction project to consumer automobiles used to get individuals to and from their place of work. What makes Chesswood's private credit product unique is the ability for investors to lend on a secured basis in return for fixed monthly payments of principal and interest. This direct lending approach to underwriting puts the lender in control of the terms of the loan, including interest rate, term to maturity, and security. This asset class is an attractive complement to traditional investment portfolios as it provides higher income yields to traditional fixed income while providing greater downside protection compared to traditional equity strategies. Chesswood's approach also produces significant portfolio diversification benefits across individual borrowers, industries, and asset types, given the small ticket nature of its leases and loans. This contrasts with many of the concentrated direct lending private credit strategies in the market today. How does private credit help portfolios? Well, the lower volatility, higher credit spread, and cash yield relative to traditional fixed income plays an important role in enhancing returns to investors. From 2011 through 2020, adding a 10% private credit allocation to a portfolio of public corporate bonds would have improved the return while reducing volatility, resulting in a better Sharpe ratio. In summary, we believe the inclusion of private credit into an asset mix benefits portfolio diversification and risk-adjusted returns. For more information on our private credit offerings, please refer to our Canadian Asset-Backed Credit Fund video and accompanying documentation. Thank you.